Let's give you the markets update now, and the local index will be chasing lost gains while the rand stages a rebound. South African markets closing in the red yesterday amid concerns over the ongoing geopolitical tensions in the Middle East. Let's speak now to Benguela Global Fund Managers Senior Portfolio Manager there, Grant Nader. Grant, good morning to you and thank you for your time. Your quick overview of how the markets are faring this morning.
Markets have started on the front foot today. We've seen stocks that moved significantly yesterday, like the precious metals, gold, platinum and the like, and some of the rand hedges. They're holding on to the gains from yesterday, up on the open. But we're also seeing some of the stocks that came under pressure, like the banks and some of the South African facing companies. They're actually up as well. So there's certainly a better feel in the market. Whether it sustains the recovery will remain to be seen, but certainly the tone around interest rates softening overnight is definitely helping the mood in the stock market this morning.
Let's talk about the latest Treasury budget data. It suggests a further widening in the main budget deficit as the total expenditure continues to grow at a very fast pace, might I add, than the revenue. Help us make sense of this data and what it tells us about the state of health of the country's coffers.
It really is a challenge. If we look, the August data shows our deficit grew by 5 billion more than it was this time last year. And if you take for the year-to-date number, it's almost 80 billion higher. So no matter how much money you earn, at some point, if you spend more than you earn, you either have to borrow, and if you keep borrowing, you have to borrow at higher rates. Until eventually you can't afford it or people stop lending to you. And so it really is a concern. I think the fiscal discipline that we so desperately need, we haven't seen it yet. The Treasury is trying, on one hand, to implement some kind of discipline, but the government's caught in a difficult position. Running into elections next year, they don't want to cut back on spending. They don't want to make the hard choices. And there's only a couple of ways out of this predicament. The debt burden grows, the interest cost grows, and subject to global rates that are rising, we're having to pay more every time we borrow, and that's eating up a bigger share of the spending budget, putting further spending on the actual economy where it's needed under pressure. And then if you add to that the fact that the social relief requirements are not going anywhere, nor is Eskom's requirements, and nor is Transnet for that matter. So the stuff that we can do to help ourselves, we're struggling to do. And the things that are external to us that require other things to go our way, perhaps are not happening yet. The rand needs to strengthen, interest rate needs to come down, and commodity prices need to rally. Those are the factors that will help from an external point of view, none of which we can control. So we are in a difficult position, and I hope some of the discipline and fiscal stability the Treasury is trying to bring ahead of elections actually starts to seep through into the government action. But at this stage, it doesn't look like they have the conviction to support those moves.
Sure. Let's talk company news. Equities Property Fund publishing their interim results for the 6 months, which ended on the 31st of August 2023. How did they perform in the period under review?
So it feels to me a bit of a tale of two stories. So they've got a very good core business in logistics and infrastructure logistics, I should say, and it's a solid business. The rental is good, the long-term leases are good. There's a lot of good things in place, but they've built this peripheral business around development pipelines, land assets, and things like that have actually been a bit of a drag on the business. The revenue is up, but their earnings were down around 20%. The distributable income, the dividend they're paying, is down about 20%. But having said that, it's still paying around 10.5% dividend yield, which is actually very attractive in this market. I think if they continue to spin off some of these non-core assets, which they've said they're wanting to do, they'll improve their loan to value, which is a bit higher at around 42%. And I think if they get this right, it's still very good business at its core, and it starts to look attractive, even though the results themselves are possibly have a little bit lacking at the moment.
Let's conclude with the annual meetings of the International Monetary Fund, that's the IMF, and the World Bank. They are kicking off this week against the backdrop of an escalating global conflict, including that the debt distress. What do we need to look out for from these gatherings?
I mean, that's a great question. We need to pay a lot of attention to that. I think what we want from them, what the market wants, is words of stability, words of calm, to indicate that in the event of some sort of escalation in the crisis, they will be the level head that provides the needed resources where they're needed, and just brings stability to the situation. What we don't want is a situation that escalates geographically and then feeds through into petrol prices or into oil prices and inflation and interest rates, and globally drives the global economies into a screeching halt. So it's going to put pressure on certain economies who are vulnerable to rising oil prices and the like, if it gets worse. And what I'd like to see them do is just calm the situation down and assure everybody that they will provide the necessary support where it's needed, even in a situation where rates are particularly high and debt is a concern globally.
Grant Nader, let me thank you very much for your market analysis there. He is the portfolio manager, senior portfolio manager at Benguela Global Fund Managers. We're going to have to look out for the outcomes of those meetings.